I think she would. She said that to me today.
Some of them might not want to run
Maybe.
here. Some of them might not want to come around here, rather than the court here.
Ready? All right, please. I pledge
allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Councilmember Jones?
Here.
Councilmember Kay?
Here.
Councilmember Knudsen? Here. Councilmember Putnam?
Here.
Councilmember Steiger?
Here.
Councilmember Walker?
Here.
Councilmember Gerberding? Here.
All righty, do you have any additions to the agenda? All right, I guess we'll go with the agenda as presented. May court staff, please, report.
I wasn't going to be here next week, so I decided to bring them up today. That's why they're printed, because I just finished them this afternoon. And they're front and back, so that I didn't waste too much paper. And if anybody has any questions.
Any council questions? Okay.
Thank you. Thanks, Kelly.
All righty, next, resolution 2014-174, adopting new investment policy.
Good evening. We talked about having our money work for us, and I told you the situation the city is that we have a lot of money just sitting there. So I've been working with Peter Becker, who works for Time Value Investment, on ways we can make our investment policy stronger. Right now it's very limiting, and it doesn't give us the options to do things that would really help us and raise, earn interest, and put our money in good investment portfolio. I met Peter through an email, but I know his boss. I work with him. I work for the city of Shoreline, and he taught me about bond investing, and I trust him implicitly. I worked with him for about a year, and so I know that they come from a good company, and he's worked with me on helping me make the investment policy more robust. And I've used the city of Mount Vernon's investment policy to just replace the city of investment policy. I talked with our attorney, and she's had a couple questions which I answered regarding our CWs, and then that it looks good to her. And what I had Peter come today in case you had any questions, because as much as I know about investments, he knows a lot more. And he wanted to come and talk to us in case you do have questions. So before I go, is there any questions you have for me, or would we just like to get Peter up here? Okay. This is Peter Becker.
Thanks, Richard. Well, thanks again for having me out, council members, and Richard. Appreciate the opportunity. Again, my name is Peter Becker. I'm with Time Value Investments in Seattle, and I have a little bit prepared, but I figured this would be a lot of Q&A. But a little bit more about us. We work with a lot of public entities. Public funds investing is our specialty as a firm. We work with cities of, to name a few, Edgewater, Milton, Fife, Sumner, Tacoma, not the city of Tacoma, Port of Tacoma, University Place, Steilacoom, Des Moines. So a lot of folks, a lot of cities all around here, and we assist them with the investment of the tax money that they bring in, and to, as Richard said, get the money working hard for the city. And I started talking with Richard, and we looked at the policy together. He has a great policy there with Mount Vernon. Done a lot of groundwork, but that's really why I'm here. Is if you have any questions about the policy or general questions about investments for the city or as it pertains to public funds in the state.
Looks like your primary change here is not in what we could invest in, but in having a more active investment strategy to pursue more gains.
Yes. Like long term, we can now do, with this investment policy, we'll be able to go a little bit longer, which will get you a lot more higher yield here in November. Peter's got some examples for you of
Yeah.
what it would look like if we'd done this 5 years ago, just to give you an example of how we can make our money work for us.
So this is a spreadsheet of, and hopefully, I think I made 10, so I apologize if I'm one or two short, but this is a spreadsheet, and ran the numbers as if 5 years ago, you can see in the top left there, $1 million was invested. So January 1st of 2009, $1 million was invested into a 5-year bond. I used the 5-year U.S. government agency bond. The rate was approximately 2% 5 years ago. That's also being a little bit conservative, a little higher than that, but 2%. You can see what we did is for each month we've got the pool yield where the city currently has its fund, and so that is roughly what the city did earn for each of those periods. And then hypothetically, what it would have earned if it invested that same $1 million in a 5-year bond, earning 2%, and then we calculate the totals for that 5-year period. And you can see, without getting too into the nitty-gritty of the numbers, I'll just direct you to the bottom right. The bond total for the 5-year period is $100,000. The LGIP approximately made the city $14,191.67, and that is a fairly realistic number on $1 million. You actually did earn that, the city did, roughly, for a difference of about $85,808 over that period. Now, it's easy to go in hindsight and say, here's what it did cost us, but right now, actually, the rates are still very similar to what they were then. Now the 5-year rate, not quite at 2% right now, but between 1.5% and 2%. And the LGIP is currently at an all-time low of 0.08. So it's actually lower than any of the numbers on this table right now. It's earning about $800 per million. The goal of expanding the policy would be to simply allow the city to take advantage of the higher interest rates that can be earned in other investments. Here's another, this is a graph, really, of treasury rates. I don't want to be jargony, but sometimes it's called the yield curve. You might have heard it referred to that way, but really just a graph of what the interest rates are. If you want to go out and invest in treasury, and pass out before I get too much farther. Actually, Richard, I'll probably end up passing out that last one. I don't know if you want to distribute the pie chart page as well, just to save a little bit of time for us when I get around to talking about that. But as you can see, so the dotted line is 5 years ago. I'm sorry, 1 year ago, not 5 years ago. And the solid line is today. What you probably notice immediately is that the solid black line, at least in the farther ranges, is pretty high, higher than the dotted line, but from 1 year and in, they're essentially the same. Well, what the existing policy prior to replacement was doing was essentially keeping the city in that flat line portion from 2 years and in. You didn't have the ability to go out and get a higher rate of return. And a year ago, 2 years ago, it was still worthwhile, but now, since rates have come up, thank you very much, since rates have come up, it has become even more worthwhile to do that, to allow an extension of maturity, because it has, in other words, it's become more expensive to stay in cash because rates are just so low to keep things in the pool, and rates have gone up for longer investments. So one of the primary goals of the replacement was to allow the city to participate in these higher interest rates that are available a little bit farther out. And I guess the pie chart, then I'll just go right into that, assuming. Actually, I'll pause right there. Did anybody have any questions about what I covered on either the spreadsheet or the graph?
Are we limited to just investing in bonds? by statute?
Instead of, what, as opposed to stocks?
Yeah.
Yes, there's a very limited set of investments that cities can participate in. Stocks are not one of them. Government bonds, treasuries, corporates are not allowable, even corporate bonds. So even, once we get into bonds and stocks, we go with bonds. Not even all bonds are allowable. So yeah, there is a very limited set. Stocks are inherently risky, a lot of ups and downs. Of course, on average, they tend to go up. But as a public entity with safety first, then liquidity, and then yield, the state has decided that, yeah, stocks are not appropriate for public funds. And what we recommend to continue on that is the pie chart, where government agency bonds are really the best option, simply because they give the safety of a treasury effectively. Government agency bonds are not explicitly treasury backed, but the treasury has always backed them. So you are getting a very safe asset. Don't have to worry about a Lehman Brothers type of collapse here. You're going to get every penny that you invested back. These are the safest assets really in the world. And it's always interesting to point out, the city is already investing in these securities. The city is simply doing it through this investment in the LGIP. And this pie chart, you can see the single largest section of the pie chart. I'm sorry, everybody else, I didn't print enough, I apologize, but the single largest portion of the pie chart is government agency discount notes, agency variable rate notes, and agency floating rate notes. So almost 2/3 of every dollar that Pacific has with the state pool is already invested in what we're talking about today. These government agencies, which are shown below: Federal Home Loan Bank, Federal National Mortgage Association, also known as Fannie Mae, Federal Farm Credit Bank, and Federal Home Loan Mortgage Corporation, or Freddie Mac. So what we're talking about here is simply taking those same dollars that would be in the pool that are earning, and pool I mean local government investment pool, earning $800 per million right now, and investing them in the same securities, the same investments that the pool is doing, but by going out longer on that graph that I showed you, the higher interest rates, you can get a better return.
How much are we looking at? What do we currently have invested in that?
Well, a little less than $4 million, right up at the 3.99. Then we had, until we purchased some property just for the last week or two, we had about $3 million sitting in our bank account. And I hadn't taken it out yet because I wanted to see where we were going with, first of all, the purchase of the property and this investment. Well, probably because I didn't want to put it all in the pool at this time. I didn't really know, once I got the cash flow of the city down, which I have now, it has to go somewhere else besides sitting there. But it's been there for well over a year, and the bank earning nothing.
And then the current policy, you're talking about long-term, what's the current policy limit at? Is there a timeline?
I think it's 2 years.
2 years.
Process that would go?
Yeah.
Aside from LGIP, or?
Yeah.
Included in it?
Well, the LGIP is a liquid account, so it's an overnight account.
Yeah, you can get it within 1 day. You get money from it.
Yeah.
Okay. And then you mentioned a 5-year bond, how liquid is that?
Good question. So a bond is actually meant to be held for its maturity. So the goal, of course, would be to hold it for the 5 years. That being said, bonds are very liquid. They're very marketable. So I like to use the example of a house versus, the LGIP. So a house, you might have equity in the building, but if you want to extract that equity, you need to sell the house, or forget about refinancing for a minute, but if you want to sell the house, it might be there on the market for months, and you cannot get to your money. So we call that a very illiquid product. Flip side of that, you've got the LGIP. Cash, money in, money out, sometimes same-day transactions. Well, a government bond, you will always be able to sell it. It's never going to sit out for 30 days or a month waiting for someone to buy it. It's one of the most liquid markets in the world. It's a gigantic market. So, very easy to sell them. But the reason why you want to hold it to maturity is because rates are always changing, and that will drive what you can sell the bond for. Now, with that being said, they're very durable. It's not like a stock where it might, drop in value by half. You're talking about very limited, typically, changes in the value of a bond. But yeah, if you had to say, hey, just how quick can we get to our money? Next day.
And then my last question is how does the city work with your firm? So do you take a percentage of what we earn, or how does that work?
Great question. So we are a broker, and there's really only two ways to make money in this industry. You're either a broker or a manager. And so a manager would do we've got 10 million and we're going to charge you 1%, so $100,000 or something per year to manage your portfolio. A broker works differently, and really we're no different than the grocery store. You go buy a gallon of milk, and the milk is $2.99 or something, and the store bought it from the dairy farmer for $1 or $2, and they marked it up to $2.99, sold it to you. They don't come to you later and say, okay, now that you bought our milk, here's our fee for buying our milk. The price of the milk was what you bought it for, then you took it home. So when Richard and I look at bonds together, I would show him a bond that is net of all commission, the yield that the city would earn. Like if I showed Richard a 1% bond, that is every single penny of that 1% yield will go to Pacific. So our commissions are already embedded into the price of the bond.
Thank you.
So there's no management fee involved. Oh, sorry.
Well, in the past, we've had some bonds or whatever, and then we come up to try to turn it to liquidate it, and they always come up against the factor where they want a discount on it.
Uh-huh. Yeah, so...
And to turn them into cash, so basically we're looking at a false revenue because they want to discount the bonds in order to turn them into cash. What we supposedly earned on them, we turn around giving away the cash. So where's our guarantee that we're not going to be faced with somebody wanting to discount them?
Right, and that's the thing, I cannot guarantee that you would not sell a bond at a discount. What happened in that scenario is simply the bonds were purchased at a certain interest rate, and then when the city tried to liquidate, rates were higher than they were when you bought the bond. And so that's why, of course, it's ideal to hold it to maturity. And we also ladder, we call it, so you have like a 1-year bond, a 2-year bond, a 3-year bond, so on, so that you've always got money coming in, so that you don't have to sell it. But yeah, I cannot actually guarantee that, because that's really saying, well, I know where our rates are going, and I wish I did. I'd be on a beach somewhere if I knew where interest rates were going. But no, the best we can do is to try and diversify our maturities so that you don't have to sell early. But even in the perfect storm scenario where you have to sell a bond early, typically, if you have to sell it at a discount, the bond has still paid you interest along the way, so you can recoup most of, or in some cases, all of that discount from the interest that you did earn along the way. That can usually soften that as well. But yeah, really with rates always going up and down, unfortunately, I wish I could guarantee it, but if you had to sell it early, there's always a potential there for it being a discount. But you would know that before you sold it.
Well, yeah, but I mean, this is always a scam deal that come in. Here's how much you're going to make. All of a sudden, we want to turn it over. Whoa, guess what? Here's a loophole in the deal. That's why we went to the state investment pool.
Yeah.
And we actually ended up, and I haven't been involved in this lately, but a few years back, our revenue was much better from the state investment pool than it was to try to play with these bonds, because at that time we had a shortage of funds, and there were things that would come up, a grant or something, so all of a sudden we had to have matching funds for it. We had our funds tied up, so we had discount of bond, and we went backwards all the time. And, I mean, you guys make money, you make a lot of money, but you give me a lot of sales pitches too, and I'm not beating you up, but I'm telling you facts.
Absolutely, yeah, that's great point. Yeah, the goal would be to hold it, you know, I guess trying to think, because, yeah, that just sounds like an unfortunate scenario where that perfect storm happened and you had to sell it in an environment where rates moved against you, but definitely can relate to that.
I can speak to that too. I had managed portfolios before, never had to sell early, but it really comes down to good management, good practices in place with a good policy, and then holding your manager accountable. Make sure you have enough in the pool and you're working with staff, so you have a cash flow that you won't be short. It's like for example, this summer through next year, we're going to have some big projects going on at Valentine and Stewart. We're going to have big cash flow coming in and out. So I need to manage that before I go in and say, I'm going to commit more than $1 million for 5 years. I wouldn't do that. I would commit maybe one, but we have all this other money we have in reserves, we have our cash flow. So I'll make sure that unless it's an extraordinary event we don't know about, that it wouldn't happen. And that's my job to do that. And it's their job to help me to do that as well. Otherwise, it changes something.
Sort of the flip side of Clint's question, I noticed in the policy under market yield, it specifies that securities may not be sold or traded if the result would be a loss of principal. Do we really want that as an ironclad rule? If we have liquidity issues and we need, if we need to sell to get liquidity,
good question.
should that be a should not be sold, or should that be a may not be sold?
I think on that so we can.
Yeah, I would say that is something that you might want to soften that up, Council.
What page is that at?
That is 3/11/150, last name.
And, because that's a good point. I mean, what you don't want to do is get in a habit of, because what sometimes folks do is they, when interest rates move in your favor, or depending on how you want to define in your favor, but if you're a bond holder and rates go down, the value of your bond has gone up. Sometimes folks say, well, we're going to sell that now and take some profits off the table. Well, unless you're going to take that money and go spend it on a road project or building something totally unrelated to the financial markets, you're going to just take that money and go reinvest it right into the same now lower rate environment that gave you your profit in the first place. So it's kind of a self-defeating thing. And that's probably the point of that section of the policy where it limits it to you can only sell if there is a gain. But yeah, I mean, that's something that I think would make some sense to do. Pretty easy, edit there to strike through that, and you're okay. But that makes a lot of sense.
Yeah, I wrote it down. Do that.
One question, I guess, talked about $3+ million of cash available the city has. I'm going to assume we're looking at, initially maybe looking at $1 million investment, or how much are we going to keep in liquid funds? And like you said, because we don't know what our net.
I don't know, I think our policy does speak to that, doesn't it? I have to look at it again, I've read it, but what I like to have is at least 50% of our policy in the pool. It kind of goes, it's tough because, Clint, what you're saying about it, at one time the pool was so liquid you didn't have to worry about going out to bonds. It was about 6% back in 2001. You can speak to this, but we're a long ways out from that ever happening again, maybe never. So if that happens, great, we have the pool, we'll use it, but right now, we're having the pool gain all this, however they're gaining, and we're getting so almost nothing for the millions we have in there. So, to answer your question, I have to make sure that my cash flow is strong enough so that I keep enough liquid to meet any of the city's upcoming current debt or projected project costs. And that goes along with our incoming revenues as well. So, we are very liquid right now, and we want to take advantage of that to build up our reserves, and this has helped.
I guess the other question I have is, besides yourself, you're looking at any other people involved as far as overseeing where the investments are going and stuff like
The
that.
finance committee would get reports every month on that, so they would know exactly where I was. What I do is I break it down by the items, so whether it be in the pool, or a one-year bond, or CDs, because I'll use all of the above for short-term. And I think the longest I would do would be 5 years for sure, and that would probably be no more than $1 million, if that much. So I'll show you that, I'll even show you my cash flow, so you can look at it, you know, comfort, it's like, do you understand where I'm going with this? That's why I've taken the time to get built up, because I wanted to do it right away when I first started here, when I thought kind of money was sitting in the bank earning nothing. But I realized it's gonna take some time, and so just let it be there, so I'm sure at least we have the money to pay our bills, right? And nobody knew coming in here, so now it's a matter of building the cash flow, working with Ken and Jim Morgan to go over what the costs are gonna be over the next year for the big project. When the grant funds will come in, and I can build this and put it together so that I feel comfortable with it, show it to Leanne, and bring it to the committee, so everybody knows what we're doing, and go for it. This doesn't work if you're not totally transparent where it's going. So that's what you'll get from me.
Anybody else have questions? Well, Council Slater?